Hello, my name is Allan Henry with Henry Sells Houses. I'm going to today talk about where to start when selling a property. The first question most people ask when they think of selling their property is, how much is my property worth? This may seem like an elementary question, but you would be surprised at the numerous, mostly erroneous ways that people use to answer it. Do not rely on the estimated value of online sale sites like Zillow and Redfin. These estimates vary widely and are not reliable in the least in most of the locations. The market value of your property is what someone is willing to pay for it. You may think that your single family house is worth $1 million, but if no one is willing to pay that amount, it's not worth that. We present a sound, comprehensive method that real estate professionals use to determine the value of real estate, from single-family houses to large commercial properties and raw land. The information will help you make more informed decisions and give you a great start in your sales process. Single-family residence. The value of a single-family residence or house is based on what other properties around it have sold for in the last 3 to 6 months. So it's helpful to compare apples to apples. Do an apples to apples comparison so that you don't base your value on completely different kinds of properties. It would do you no good to compare a 750 square foot one-bedroom bungalow built in 1910 to a 2,500 square foot four-bedroom house built in 2014. For a true comparison, find properties within a half-mile radius that were built in the same era and are of similar condition, size, and style. Values can change from block to block, and it's important to remember that busy streets, the views, neighboring properties, proximity to neighborhood amenities, and aesthetic styles can affect the values. Ultimately, the market value of a property is determined by how much somebody is willing to pay for it. 2 to 4 unit multifamily is going to be treated different than 5 unit or multifamily commercial properties type opportunities. 2 to 4 unit multifamilies are duplexes, triplexes, and fourplexes. These are to be considered residential real estate in the eyes of lending institutions. Buyers of these types of properties can obtain the same long-term, low interest rates and low down payment financing for 2 to 4 unit property as they would for a single family house. This makes these types of properties popular among buyers. With the low unit count, they are easy to manage without monopolizing your time or forcing you to hire a property manager. These types of properties are valued similarly to single family houses in that they're based on comparable properties that have sold in the area in recent months. Sometimes it's hard to find as many comparable properties as single family houses, so extending the geography boundary can be helpful. Values will also fluctuate based on location, zoning, condition, bedrooms, bathrooms, size, style, etc. Watch out for real estate agents who shop for a listing. What does this mean? It means that agents make their living from commissions. They do not get paid unless the transaction closes. It is common for agents to overinflate a comparable market analysis, or otherwise known as a CMA, or the sales price, and tell you that they can fetch a great price for your property. If a property sits on the market, goes through several price drops, and doesn't sell, sellers start to question the commissions they will be paying the agent, and they get so frustrated from the lack of results. Now, do not rely on Zillow or Redfin to determine the value of property. These sites use aggregate market data and formulas based on square footage and general location to estimate the value. These values vary widely and should not be used as a realistic indicator of market value. Alright, now if you have 5 or more unit, it's considered multifamily. So 5+ unit multifamily is considered commercial properties. So any time you have a property with 5 units or more, it's considered a commercial multifamily property. These are valued differently than single family houses and smaller multifamily properties. The income of the property is what determines the value. To value the property, you use the net operating income, or otherwise known as NOI. The NOI is determined by assessing the gross annual rental income minus or less annual operating expenses, such as landscaping, property management, maintenance, taxes, insurance, etc. Do not deduct expenses from the debt service, mortgage payment, or capital improvements. For example, any remodeling or substantial upgrades. The debt service that the seller pays will be different from what the buyer would pay after the sale, so this is not applicable, and capital expenses are not regular operating costs. Now, value equals net operating income divided by capitalization rate. The annual net operating income, or the NOI, is divided by a capitalization rate, commonly referred to as a cap rate. A cap rate is a market-driven rate that looks at the risk versus reward of a property. It is expressed as a percentage of what a buyer would accept as a yearly financial return if they were to pay all cash for the property. You might be lost, but that's okay. Let me explain this. Buyers of investment properties care about their financial return. They are not going to live in the property, so they want to invest in properties that will yield a return. Investment returns are measured by risk. In the real estate world, this means the lower the risk of a property, the lower the return the investor will be willing to accept. The investor feels secure knowing that the property will hold its value. Conversely, if a property is riskier because it is in a different location or needs more work, an investor will want a higher return on their money. The risk-reward factor here is the cap rate. To get a sense for your market, find properties similar to yours in an area and see what cap rate they're trading at. So here's some examples. In the following examples, I'll demonstrate how this works. A 10-unit property in an ideal downtown location in great shape and with nice curb appeal will be perceived as a stable investment. It is a Class A property with plenty of tenant demand in a fantastic location in a city with a robust economy and a high quality of life. The return that an investor would receive if they purchased the property, assuming they paid all cash, would be lower than if they bought the same building in the suburbs. Let's assume the cap rate for these kinds of downtown properties is 4.5%, but in the suburbs the cap rate would be 6%. But just remember that the investor wants a higher return for riskier investments. Let's also assume that the net operating income is $100,000 per year in both locations. The math to determine the value is pretty straightforward. Net operating income, capitalization rate, net operating income divided by capitalization rate, that would equal the value. So on a downtown property, $100,000 divided by a 4.5% capitalization rate equals $2,222. 222. On a suburban property, the $100,000 divided by 6% would equal $1,666,667. So roughly over $1.5 million. The values are different even though the income from the properties is the same. Cap rates always differ for different kinds of properties and assets. So for example, a mobile home park will be perceived to be a much riskier investment than a multifamily property, and that will have a higher cap rate than the multifamily. An office building will have a different cap rate than an industrial building, and so on. A contributing factor for commercial properties is that they can sit on the market for a long time if they have a low cap rate, because the cap rate is usually based on the sales price. So A contributing factor for commercial properties that sit on the market for a long time comes from a low cap rate that the sale price is based on. The seller wants to maximize the return and will advertise the property at a lower cap rate than what is consistent with the market. It's making it more expensive in essence. The property sits and no one is interested. This happens on a regular basis when a seller bases the sale price on what the buyer could get in return because there is room, per se, to bump the rents, or the expenses are high, or we chose not to rent that unit on purpose, kind of excuses. We put these examples in sarcasm or quotation marks because the sellers commonly use these lines, which are nothing more than smoke and mirrors, dog and pony trick shows. The market assumes that if an owner could receive more income on a property, they would have done so, and thus the value is derived from the known income of the property. Most buyers will not buy based on future anticipated rents if they are the ones taking on the risk and doing the actual work. Now let's talk about land. Land values are based on the potential use of the property and measured by the price per square foot. For example, let's assume a 50 square foot by 100 square foot lot is a standard residential lot size. If a builder can build just one house on the lot may be valued at $30 a square foot for a total of $150,000. So that'd be 5,000 square feet times 30. However, if the zoning allows for more density, such as a 5-unit property, the price per square foot increases. Instead of a $30 per square foot, it may be $75 per square foot and be valued at around $375,000. If the zoning allows for a large mixed-use building with lots of units or commercial tenants, the lot may be valued at $150 per square foot for a value of around $750,000. So the potential use determines the value. Finding properties that have recently sold in similar zones and locations is a good way to determine the appropriate price per square foot. If the property is rural and has natural resources, timber, oil, gas, minerals, etc., the value will change based on the estimated value of the natural resources. In this case, it's prudent to speak with a professional who specializes in that kind of property, as they will have a good understanding of its value. Now remember, do your homework or ask a professional for guidance when determining the value of your property. And do not trust online property value estimates. 1 to 4 unit properties are valued on comparable sales in the area, and 5+ units are valued by the income of the property. Land is valued by the productive or potential value. So I hope you've enjoyed this video about how to estimate what your property's worth and how to go about valuing your property and where to start. For more information, please watch my next videos or contact me at henrysells.houses.com. Thanks and have a great day.